Good afternoon, everyone. We'll start the webinar. I'm so pleased with the attendance, and I know more people will join and as we progress. So this webinar is really to disseminate the findings from a study FSD did in conjunction with SASRA and KMRC. It really dug into the role of SACCOs in housing finance. And the trigger to undertake the study was a SASRA 2022 annual report that we saw that showcased that the largest loan product SACCOs provide is land and housing. So in the 2023 report, we saw land and housing accounted for 30% of the combined SACCOs loan book, much bigger than any other component, including education, manufacturing, etc. And this is not new news. It was just a very strong data point. We all know what an important role SACCOs play in enabling Kenyans to get access to land and housing, but we wanted to take a deeper look at it. We also know that Kenya is the first country in which SACCOs have been involved and as primary mortgage lenders in the Kenya Mortgage Refinance Corporation. So that was the real impetus for undertaking this study. Separately, I do want to say another collaboration FSD and SASRA have been undertaking over many years under our policy and infrastructure program, where we're undertaking in conjunction with World Bank on creating a shared services platform to improve efficiencies and lower costs for the SACCOs, and that's called the SACCO Central Initiative. And another one is where we worked with SASRA to undertake a remittances survey and understand the challenges and opportunities for remittance payments by SACCOs. And we're now creating a simple toolkit for SACCOs to enable easier remittances. So I want to that's all I have for opening remarks because there's such rich information to share. I want to thank each of the participating SACCOs to undertake this study with our consultant AIS. And with that, this forms part of what we've launched as the Open Access Initiative with other members in the housing finance space to say whatever research or whatever learnings we have, we would like to share them with other stakeholders so they start the next bit of their work building on what another member may have created. So we're pleased to disseminate these learnings. And with that, I'm really pleased that this Acting CEO, Mr. David Sandagi, has joined us. He's created time in his schedule to just give a few remarks, and I hand it over to Mr. Sandagi, please. Thank you so much.
Right. Thank you, Sita. And indeed, participants within this webinar, in particular, the KMRC, FSD, as well as our regulators, that's the SACCO societies, that fall under the ambit of the SACCO Society's regulatory authorities oversight. My name is David Sandagi. I'm the acting CEO of SASRA. And let me take this early opportunity right from the onset to recognize and appreciate the partnerships that we've had with KMRC as well as FSD, and looking at the work that we've been able to partner, particularly with FSD on, in terms of developing the space that we regulate across various frontiers, as you have mentioned, Sita. Kindly, take this as a point of appreciation to yourselves as development partners and the rich engagements that we've had to unlock areas of support and development within the SACCO ecosystem. I think it's important for me to mention that we have been 15 years in existence, a period within which we have grown from 300 billion in assets in terms of the regulated SACCOs to close to 1.2 trillion shillings in total assets as we speak. When we disaggregate the numbers, we get to appreciate that loans form consistently over 80% of the assets of regulated SACCOs. And therein comes the role that SACCOs really play in intermediating within various sectors of the economy, and in particular, land and housing. And now specific really to this study, And looking back at the year 2024, and in particular from the basis of our SACCO supervision report of the year 2024, where we appreciated the fact that SACCOs have been able to play within key economic sectors, and in particular land and housing. For the year 2024, what we were able to assess is that the SACCOs disbursed in totality about 550 billion shillings across key sectors of the economy. Interestingly, again, out of this level of disbursement, a significant quantum went to land and housing, specific to about 26%, representing over 130 billion shillings within the year went into land and housing. Which then demonstrates the fact that SACCOs intermediate quite heavily within the land and housing space. And as we look at that intermediation and the role then that refinancing of land and housing through KMRC comes in, we appreciate that, yes, whereas SACCOs have played within this space, how they then intermediate in facilitating land and housing may be a bit different from your conventional definition of what a mortgage is. Because what we observe is that the modalities that SACCOs use to intermediate within land and housing is from an incremental level, where one, they support purchase of land, and thereafter incrementally facilitate construction of dwellings. And by that, then, whereas the meaning of the term mortgage may not necessarily apply directly in the manner in which SACCOs intermediate within that segment, we note that they are heavy players within the land and housing sector. So what we have also observed is that, yes, we have a few SACCOs that initially signed up to KMRC, and the question is, to what extent can we then get other SACCOs that are yet to sign up to KMRC as shareholders get to access the refinancing facilities available from KMRC? Secondly, the SACCOs that are currently shareholders within KMRC accessing refinancing facilities, to what extent can that be broadened, so that then SACCOs can participate in an even deeper way? And hence comes the study in terms of appreciating certain challenges and, projecting opportunities. And we really look forward to AIS Capital to disseminate the findings of this study and see how best we can then leverage KMRC to ensure that our SACCOs are able to play in a much deeper way within this economic sector. So mine is to really sit back and wait to appreciate the findings, and once again to really reiterate our appreciation to our partners, FSD, as well as the engagements that we've had with KMRC right from the very onset, and hopeful that we can then unlock financing or refinancing for that matter in a much deeper way, so that SACCOs can really do what they do best. And this is to intermediate across the economic sectors, but in particular, land and housing. So that is it from me. I wish us all insightful deliberations, and really back to you, Sita, to take us to the next course of the program. Thank you very much.
Thank you very much, Mr. Sandagi. And we are also appreciating Evans Kimosop's attendance on this webinar. He was part of the task force from SASRA that supported the work, and he will help with the Q&A as Mr. Sandagi needs to leave. And now I'd like to ask Mr. Josiah Kiplangat from KMRC to give a few remarks on behalf of his CEO. Josiah also participated very strongly in our work in our task force for this report. Thank you, Josiah.
Thank you, Sita, and thank you, CEO SASRA. And I think distinguished partners from FSD Kenya, SASRA, the SACCOs, and all participants in this webinar. Good afternoon. As already introduced, my name is Josiah Cheriot. I'm currently the acting head of research and strategy at the Kenya Mortgage Refinance Company. And really to continue appreciating the partnership that we have for some time now been undertaking to really understand the market dynamics in the environment that we continue to operate in. I think the CEO from SACCO has pointed out the fact that KMRC has been supporting the refinancing of our primary lenders, the banks and the SACCOs, over the last couple of years. So KMRC was established in 2018 and is licensed and regulated by the central bank under the mortgage refinance regulations of 2020. And since then, we have been able to refinance over 24 billion worth of home loans across the banks and the SACCOs that we have partnered with. And notable to mention is the fact that SACCOs have continued to play a significant role in the refinancing operations by the company to a tune of 15%. And the CEO did mention the CEO of SACCO rather did mention the fact that we have been working with a select number of partners in the past, but in 2024, that's July, we took a strategic decision and recognized the need to really widen the pool of participating institutions, and therefore, effective July of 2024, we've continued to onboard additional banks and SACCOs that are prudentially regulated, with a view to ensuring that the product that we offer in the market is therefore available to our members. And we continue to see the SACCOs to be the frontier of our growth. We do understand that SACCOs play a very critical role in reaching the unserved and underserved segments of the market. And hence, the study findings that are being disseminated today will really play a critical role in enabling us grow the market and ensure that our mandate of providing home ownership is realized through our partners, the banks and the SACCOs. So I urge all of us to really seize this opportunity to build a stronger, more inclusive and resilient affordable housing financing, with SACCOs at the core of this. And I urge all the participants in this webinar to engage openly, to share their insights and collaborate as we work to unlock new possibilities for affordable housing. With that, I thank you all and looking forward to insightful conversations. Thank you, and back to you, Sita.
Thank you to Josiah. And again, this was a really enjoyable project for all of us because of the very engaged nature of all the participants in the working group and the support we got with SACCO and KMRC to onboard SACCOs to really share the data needed to get these learnings. So with that, I'd like to hand it over to AIS. We're joined by Leonard and Stephanie. And I really, hand it over to just walk us through the study. We've structured it such that there'll be enough time for Q&A at the end. Thank you.
Thank you, Sita. Good afternoon, everyone. We have a presentation, and Stephanie's putting it up. Thank you. So we are AIS Capital Advisors, and I lead the team, and we were privileged to work with some of you in this study. So we'll go through, I'll do an introduction, and then Stephanie will go through the key findings and recommendations. So in terms of the background, so just to give an introduction. So the study basically aims to better understand and enhance the role of SACCOs in housing, in land and housing. And we basically had different steps through the last couple of months in undertaking this comprehensive review. So we had, together with the working group, we did select SACCOs and embarked on collecting data and information about their participation in the land and housing value chains. And then we did conduct some focus groups, and this entails one focus group, and then we had, which was in person, and we had virtual discussions. And then we did analyze the data that we got from the information from SACCOs, and also what we got from the focus group, and also the individual discussions that we had. And from that, formed the basis of the report that we submitted to the working group, and now we are doing the dissemination after various iterations. So this is a basic overview of giving a background of SACCOs. Most of us know, but just some to enforce the importance of SACCOs. So in looking at the universe, there are around 15,000, 14,484 registered as at December last year. There is a regulator we've heard from the acting CEO. So this is a regulated sector. But then not 100% of these 40,000 are under regulation by SASRA. I think 355 were regulated as at last year, and that includes all DT SACCOs and non-withdrawable deposit-taking SACCOs with deposits over 100 million. When we go around thinking or looking at the whole financial market ecosystem in Kenya, some of us may say that SACCOs are smaller compared to banks, and indeed they are. And if you look at the sizing, now look at the number of entities. So they are around 355 compared to around 39 commercial banks. But also the commercial banking sector is around 7 times larger than SACCOs when you look at total assets, and around 5 times larger when you look at in terms of gross loans. Also, if you look at the reach, the banks are 15 times more than the SACCOs, and also the banks have a wider physical presence across the country. Yeah. But then when you look at the intervention in land and housing, you will realize that a large portion of SACCO loans are used to finance housing compared to what banks are doing. So this way you could think like the whole SACCO ecosystem, and in terms of management time, in terms of processes, we can see a bigger proportion, actually almost a third of the intervention goes to land and housing, if you include that portion of now, which is pure mortgages. And the CEO of SASRA mentioned around 25, 26 for pure land and housing. But if you compare that with banks, is a smaller portion of that. So this is critical in terms of when you think about intermediation into land and housing. Really, from a policy perspective, you can't really ignore the role of SACCOs. So we used a mixed method approach when conducting this study. Most of this was data analysis, so highly quantitative, but there was also qualitative in terms of talking to both the SACCOs management, the operation staff, and SACCO membership. So we started by filtering SACCOs, trying to figure out, because we didn't have time to talk to all of the SACCOs, and so we had to select certain well-representative sample, looking at the strategic interest in land and housing, and also looking at the SACCO size, and also looking at geographic locations, so that we have a well-represented sample. Then in terms of data collection and analysis, we had management interviews. We looked at the loan portfolio and did a lot of analysis. And then we looked also at the SACCO processes, plans, policies, just to understand the approach and execution in terms of dispersing and portfolio management of land and housing loans. We did a bit of desk research and the focus groups. So there were a couple of limitations here, although we did receive, in terms of good participation, some SACCOs have experienced challenges in extracting requested data, and this could be due to system issues. Some of these also could be the timing of the study. We came in when you're busy with your reporting, but eventually we got around some of these setbacks. Also, we didn't get most of the loans that we did request, and in some of the reports we've taken back to the SACCOs, we are trying to discuss with them how they could improve on this. I think I'll let Stephanie explain the key findings and the recommendations from the study. Thank you very much.
Thanks, Leonard. So I'll just start with a quick look at some of the features that, the joint features of the participating SACCOs. So I don't know if Leonard mentioned this, but there were 19 SACCOs that participated in the study, which is quite a large number. All of them are DT SACCOs. Most of them are classified as larger. So SACCO has a way to classify SACCOs based on their assets, and most of them are on the larger, in the larger category. Around 58% of them are refinancing with KMRC, but all the ones we talked to are either in conversation or have recently been included or pursued a partnership with KMRC. In terms of geographic coverage, we looked at this from a branch perspective. So if you look at this map here, a lot of the counties, 35 out of 47 of the counties are covered by the participating SACCOs just based on their presence, physical presence with the branch in the different counties. And then lastly, we looked at the common bond status, also what SACCO uses, and majority of them are government-based, so mostly serving either public servants or teachers. So that's a good overview of the SACCOs that we worked with. And now we'll go into some of the findings that we had. So we'll first look at some of the products, and then we've grouped it based on different themes. So beginning with the products that the SACCOs use, or members within SACCOs use to finance land and housing. An interesting thing we noted is that there's multiple different types of products that members use, not just the ones that are designed specifically for land and housing. So we created different categories just to make sure that we have bucketed the products into different categories. But as you can see, some of them used as many as 32 products within the SACCO to finance land and housing. So an interesting insight here is that there are some loans that are demarcated for different sectors like agriculture, education, and medicine or medical uses. And these are also some of the loans that were taken out for financing land and housing. But then the main type of product that was used were general development loans, and we'll discuss more of that in the rest of the presentation. The other finding is that there were shorter term loans, either designed for emergency or designed as an advance, that were also taken out for land and housing. So members use these despite them being slightly smaller in terms of ticket size in most cases, and also more expensive than your general development loans or even mortgages that are refinanced by KMRC. Yeah. So looking at the purpose of the loan, so we broke this down based on what SACCO calls economic sectors, and then these are the sub-economic sectors within land and housing. But then we also have mortgages, which are usually bucketed differently based on the economic sectors, but we just broke those down as well, just to see what mortgages are the different uses that people take out mortgages for. So looking at this, as mentioned by Mr. Sandagi, a large portion of loans, or the largest portion of loans, went towards purchase of land. So members purchase land for development purposes, mostly for different types of housing or investment in residential units or commercial property. So as you can see, the top purposes are purchase of plots, and then immediately followed are construction. So that's one thing that we noted. Pretty much tells a story of how members were to first buy land, and then now they start thinking of construction. If you look at the ticket sizes or the average principal sizes of these construction loans that are not mortgages, they're quite small, which also speaks to the incremental way of building that members typically do. So they take on small development loans to build slowly until they get to their final goal, whether it's a single residential unit or something else. Yeah. Then we looked at interest rates for the different loans that were used for financing, also grouped based on the product categories. So one thing to note is that the range is largely between 8 and 16%, but some of them are on the higher side as well, especially the shorter term loans if annualized. But you can see mortgages are at this point the cheapest based on interest rates, ranging from 8 to 10%. Some are even lower if they're staff loans, but then the ones that are issued to members are at around 8 to 10%, and this is mainly afforded by refinancing from KMRC. Those SACCOs that did not have refinancing from KMRC had their mortgages a bit higher, in terms of rates, maybe ranging from 12 to 16%, some as high as 18% as well. Yep. Then we looked at the tenure of the loans. So once again, we see that a lot of the loans, especially focusing on the general development loans, are medium term, between 3 to 5, the 3 to 5 year range. We do see some of the shorter term loans as expected being below 1 year. These are mainly used for small, or either to top up basically for different uses of the loans that have been borrowed. But then as we see mortgages coming in and more people borrowing mortgages as SACCOs introduce mortgage products, more people are skewing towards the longer tenures. So a lot of the mortgages, or majority of them, were at 9 to 10 years. So people not yet fully taking advantage of the 25-year period that's available to them, especially for the refinanced mortgages. But then there's a slightly higher peak as well at around 15 years. So people are starting to skew towards the longer tenures as is afforded by mortgage products compared to the other products, including general development loans. Okay, so the first thing we looked at was affordability. And under affordability, the first thing that we'll consider is monthly income for borrowers. So we collected data on monthly income for the borrowers who took out loans for land and housing. And unsurprisingly, a lot of the borrowers had incomes which were at or below 100,000. So this may not be an income that can enable a member to qualify for a large loan borrowed at once. Hence the culture to borrow incrementally. So taking on a loan that you can actually qualify for, whether it's small, and building your house slowly by slowly. So that's the trend, and it's really supported by the income that we see. A few, especially the mortgages, we can see a few being slightly higher than that, but still ranging from 100 to 200,000. So that's the second income bucket we had, which is not that significantly higher than the first income bucket. So this just speaks to affordability and the fact that members that are members of SACCOs borrowing have different borrowing cultures. Mortgages are coming in, but it'll also have to consider some of these income aspects of SACCO members. Yep. Then the other aspect we looked at under affordability was how pay slips are being affected. So if you're a member of a SACCO and you earn a formal income, basically, there's the other side of it. So if you're earning below, for example, 100,000, as we noted, most borrowers do, then the other side of it is how your payslip is being affected by deductions. So we've seen a lot of increases and changes in deductions, which have affected the take-home pay of most of these SACCO members. So here we have a different, we have a table that looks at the scenarios from April 2022 and then how that changed in April 2025. So with increased deductions, the net take-home pay for someone earning 200,000 decreased, sorry. It doesn't look like a significant decline if you look at the net pay line, but then it really affects the principal that such a member would be able to afford. So just looking at this principle, assuming the member doesn't have any other loans and can fully utilize their payslip, then there's a significant reduction of about 300,000, which can be used for multiple things. But that's being taken out towards deductions. So this has affected affordability to some extent, just because it affects how much someone can actually borrow for land and housing, especially for housing. But then it also affects those who had already taken out loans, and these deductions affected whether they are within their third rule. So if there's a breach there, then SACCOs naturally expect there to be a few more delinquencies just because of the decline. Yep. And then the other thing we looked at with regards to affordability is the upfront costs that are incurred, especially when you're taking out a mortgage or even a property-backed loan that's not necessarily called a mortgage. So here we have a scenario where we look at someone who is already has a piece of land, but then we looked at two scenarios: whether they would borrow for a mortgage, they would have to incur multiple costs just related to charging the property, while someone who already has a piece of land and takes out a development loan that's backed by guarantors would not incur the same charges. So this is a big deterrent for borrowers, and this is something that they look at keenly before they decide what product to take on, and 9 to 10% that even would not be fully financed by the 105 financing that not all borrowers qualify for, but some do, is a big factor that they consider when taking out loans. So this is a huge challenge when it comes to affordability of mortgages for SACCO borrowers. And then the last aspect is construction costs. So we've seen a steady rise in construction costs, and this data just looks at this rise from 2021 to 2024, and it's been rising steadily across all the different types of housing units that one would construct. So this increase in costs has been driven by various aspects, but mostly around tax policy. There were a few supply chain issues during COVID, but a lot of them have been around tax policy, especially considering that a significant share of materials are imported. So there seems to be a mismatch there in terms of policy. There's a push towards getting more people to own homes, but at the same time, some of the tax policies are deterring this just from an affordability perspective, and affecting people's ability to own homes or the homes that they want to own. Okay, the next theme that we looked at was access. So here we looked at it from two perspectives. The first one we looked at is around the different types of products that are available to members. So as I mentioned, general development loans are overwhelmingly the largest share of loans or the type of loans that members use to borrow or to finance land and housing. Mortgages is lower, but is a growing portfolio. So mortgages are newer compared to general development loans, which are more of a legacy product. They've been issued by SACCOs for years. Mortgages have just been recently introduced by many SACCOs, especially with the introduction of KMRC. So we're seeing this growing, but obviously on one side affected by certain things that are not there for general development loans, mainly the security, for example, but as well as the complexity of the process. So there's that in terms of just limiting access from a mortgage perspective, but then there's also the awareness bit. So a lot of people are still not aware that they can access mortgages that are refinanced by KMRC and that they're offered at a lower rate, fixed interest rate over a longer period. So that's also affecting access of mortgages. And then when we looked at it from the gender perspective as well, just to see which genders are borrowing more or have more access to land and housing loans. So as you can see, the bottom half that's darker green is male borrowers. And for most of the SACCOs, over 50% of their loans have gone to male borrowers. So this is a factor of the SACCO membership. A lot of SACCO members are still male borrowers, so then it ties back into them being the main people who are also taking on more of the loans. But then there are also other aspects just within the society, cultural, for example, cultural definitions of roles of men and women when it comes to home ownership or provision of a home, and those are also affecting borrowing. The other aspect that we got was just around risk. So men are more likely to take on more risk. So then a lot of the SACCOs noticed that then they're more likely to take on these larger land and housing loans as well. But then there's still more that can be done to increase membership of of women in SACCOs, as well as their investment in land and housing. The third aspect we looked at was awareness. So I alluded to this, but then we looked at it from different perspectives. So there's awareness of KMRC mortgages. This still remains moderate. And it was also something that we noticed when we talked to members in the focus group. So a lot of the members that participated in some of the focus groups had taken out mortgages refinanced by KMRC, so they knew about it. But the ones, especially from SACCOs that were not refinancing or partnering with KMRC, most of those members did not know about KMRC mortgages. So awareness is pretty low, and more can be done to increase awareness among the public. Then the other thing that many people are not aware of was the mortgage interest tax relief. So this has been there for a number of years, but then awareness and utilization remains low. As you can see, 4.5% from the KNBS survey that was done in 2023-2024. So it's very low, utilization is low, and since the incentive or the subsidies there, it really should be utilized. One reason that was called out was that it seems like a low amount. So the allocation is that if you have interest of, if you're paying interest on a mortgage that's financing a single occupancy home for for that and the interest on a monthly basis is 30,000 shillings, then you can actually claim that relief. So it's featured in, if you have, for example, a formal income, it's featured in your payslip, and it basically reduces your taxable income and reduces your PAYE as a result. So then your net pay is higher on a monthly basis. So if you look at it from just a single month, as you can see on one of the charts there, the saving there is 9,000 on a monthly basis. So it seems like a small amount, but then if you look at it for the duration of a long-term mortgage, assuming 25 years, then you can save as much as over 30% of your mortgage principal. But obviously that's not considering the time value of money. But it becomes significant if you look at it from a longer term perspective, of which most mortgages are. Okay. Then the last thing we looked at was process and disclosures. So we looked at the lending process for land and housing loans, which includes general development loans, but then also for mortgages. So the mortgage process is quite lengthy and complex compared to the process of getting a general development loans. So some of the issues called out by members we talked to in focus groups were at the origination stage, they would either receive incomplete information or incorrect information, especially about KMRC mortgages, and this created some sort of frustration, delaying the process, because then it takes a lot longer to understand the product before they can take it up. But then I think the longest part of the process that's pretty much out of the control of SACCOs or even the members is the last part of security perfection. So this can take quite a bit of time depending on the land registry, and this has been called out as a big challenge both by SACCOs, but also by members, because it takes much longer. And if you compare that to general development loans that can take a few days to clear, it really deters some members from taking on mortgages compared to other types of loans. Okay, then we looked at the recovery process. So this was another challenge that was called out and also reinforced by the KNBS Housing Survey, where 36% of SACCOs cited the long and complex process as a challenge for property-backed loans. So we pretty much laid out the process, looked at what's more of a guideline and what's backed by Lands Act or guidelines for auctioneers that need to be adhered to. And the process takes around 219 days. This is when it's very neat and clean, but when there are other factors included, for example, if the borrower takes the lender to court, then it can take much longer than this. So what we noticed is that SACCOs do a lot in the beginning, especially to just make sure that they come up with a resolution plan with their members before even going through this process. So SACCOs do this a lot, especially since members are shareholders, and we noticed that the relationship between members and SACCOs can be more personal, especially for the smaller SACCOs. So then they have access to even credit managers who can support them through this resolution plan before they embark on recovery. So moving on to some of the recommendations that we have, I'll start with those that are related to products. So from the findings that we had from the study, one thing we noticed is that incremental building is pretty much what members have been borrowing a lot to do, or how they end up with a house is through incremental building. So if a product can be designed that mirrors this borrowing habit, and then figure out a way in which it can be refinanced so that it's accessible to members at a lower rate for a longer period, I think this would be a product that would see a lot of uptake. Obviously, one of the key things that would need to be figured out is the collateral in such a situation. But then thinking about such a product and how the design would look like, I think would go a long way in terms of including more SACCO members into the fold of benefiting from refinanced mortgages. Then the second one we have is around buy and build products. So this would be a product that enables you to buy land and build, and all of it is financed in one mortgage. So this is a product that KMRC is actually already refinancing. Banks already have this product. One finding is that if you look at what the loans that members are using to finance, for example, land, if they use a general development loan that's around 12 to 16%, it can be cheaper with a buy and build loan, because then all of it can be financed at around 8 to 10%. So having a buy and build product would be really key. And I think it also matches what SACCO members are doing, which is buying plots and then constructing. Then the third thing around product is just increasing either uptake or increasing the products that are there for joint borrowing. So as we noted, a lot of the members earn at or below 100,000. So if there are two income households with that same income, if they combine their incomes, then they can qualify for a larger mortgage that can better match some of the aspirations they have towards home ownership. So all these would be initiated by SACCOs. Obviously, the SACCOs have to be the ones to initiate the introduction of new products or design of new products, and then SACCO would come in to approve. The next set of recommendations we have were around processes, staff capacity and training, and then supporting members. So the first one is just around building capacity of staff, especially when it comes to mortgages, which are still fairly new, and ensuring that staff understand these products better will reduce some of the challenges that we saw, especially at the origination stage, where members can now receive more complete information or correct information. Another way to handle this is the second recommendation, which is just ensuring that the SACCO has a KMRC product champion, if that's not already in place. So this would be the person who would make sure that all staff are well trained and informed on KMRC, would liaise with KMRC to make sure that they're trained and informed on any new introductions or changes. And they would basically be the backstop of ensuring that everyone within the SACCO has good information, correct information about KMRC products. The third one we have is around reconsidering how recurring valuations affect the cost of having a mortgage. So this is typically something that SACCOs define. So most of the SACCOs we talk to have revaluation every 3 years if you have a mortgage product, which can be quite costly for a borrower if you have to keep paying for revaluation every 3 years. So reconsidering what those requirements are while still maintaining any risk mitigation measures that this covers would really go a long way in terms of increasing affordability for members. The fourth one we have is offering a practical solution towards supporting members in construction. So we did see some SACCOs actually doing this, either through providing or working through the housing cooperative to provide certain types of support to members when they're doing construction, mostly from a project management perspective, or basically having partnerships in terms of the way they have list of, for example, valuers or a legal team, then also introducing a vetted list of development partners who can then support members when they want to do construction. This will help reduce cost overruns that a lot of members complained about when we talked to them in focus groups, but it also increases the quality of homes that they end up with if they work with someone who's vetted and vouched for. Then the last one here we have is around introducing interventions to support more women to join SACCOs as members, but also to invest in property. So we're seeing this trend shift a bit, especially with women getting more empowered, more women are investing by themselves in property. But then I think more can be done just to make sure that they are aware of the products that are available and that they take up the products that are available just to increase the borrowing from the female perspective. Okay, yeah, so a lot of these interventions would be led by SACCOs as well, implemented internally just to improve processes and also increase uptake by members. Yeah. Then the last set of recommendations are those that are to do with the ecosystem and enabling environment. So I'll go through this in 3 slides. The first one is around awareness as well and increasing utilization and uptake of the existing incentives and subsidies that are there. So as we covered, a lot of members do not know about the mortgage interest tax relief, about KMRC mortgages, and even about the stamp duty waiver. So increasing awareness from that perspective, directly engaging members, educating them, which SACCO is already doing, but just figuring out different ways to do this by SACCOs as well as by KMRC can really support awareness and hopefully increase uptake. I think the one issue with the waiver is that it applies to these government projects. So if this can be extended to all development projects, as long as someone is buying a home as a single occupancy, then this would really go a long way as well, just to reduce some of those upfront costs that members have to incur when taking out mortgages. Now, the second one we have is how to enhance the mortgage interest tax relief. So currently how it's structured is just based on a single amount that's defined of interest. So if you're paying interest of 30,000, you can claim the relief of 30,000 up to 30,000. So if it's above that, you can only claim 30,000. If it's below that, you can claim the full amount. But then how to make it a bit more beneficial to low-income households would be to make it a percentage of the mortgage amount. So if it's a percentage of the mortgage amount, and then you have bands such that a smaller amount, for example, would have a higher percentage of relief, then that will make sure that the relief actually benefits more low-income households, as opposed to benefiting people who can already easily access and afford mortgages. So these interventions would have to be a joint effort by SACCOs, by KMRC, but also by housing policy organizations that can help to lobby and support the government to make some of these changes. Okay, and then the third one around ecosystem is government, the proposal by government to reduce the basically the recovery period. So that was one of the challenges that I called out, and the government proposed to reduce the 90-day statutory notice period, but just for affordable housing program. So if this reform is actually passed, then it would be good to extend it to all developments, just to make sure that everyone is benefiting from this, including those people who are not purchasing affordable housing program units. Then the fourth one here is around private treaty. So private treaty is one other legal avenue that can be utilized for recovery. But then we noticed that it's underutilized by SACCOs. So from the KNBS report, only 18.5% of SACCOs do this, while almost over 80% of banks use private treaty. So one other way to make sure that it works well, because at the moment it's usually on a case-by-case basis, so it's usually negotiated from one loan to the next. If there's a way to institutionalize this so that there's an institution actually purchasing all these non-performing loans and their backing properties, then that will help to basically do recovery, but from at a bulk level where you can tell most of your NPLs backed by property to an institution that can then figure out how to develop the property. Yep. Then the fifth one, and that would release whatever funds the SACCO is holding, that can then be used to go back into the lending process. Yeah. Then the fifth one here is around aligning tax policy with housing objectives. So as I mentioned, a lot of the challenges that are increasing or issues that are leading to an increase in construction costs are still tax policies by the same government. So if those two things can be aligned, just to make sure that they're sticking to each other. So policies affecting construction costs should be relooked at, just to make sure that they're not affecting policies to do with or objectives that the government has on housing. Then the last one here is around ensuring that there's an adjustment that any adjustments to land transfer fees are basically considered from an economic perspective, what's going on in the economic environment, and then there's ample notice before any introduction, just to make sure that anyone who's looking to own a home knows that these costs are going to increase and they can plan ahead. But then if the prevailing economic environment doesn't support, then there should be considerations around how to increase it at a later point, or figure out how to work that in so that it doesn't affect homeownership goals and the cost that prospecting homeowners have to incur. Yeah. Then the last one here is to introduce a pre-financing facility. So at the moment, some SACCOs, especially the smaller ones, struggle, especially for building the first mortgage portfolio before it can be refinanced. So a pre-financing facility can support these SACCOs to build a portfolio, to basically finance the SACCOs to build a portfolio that can then be refinanced, so that it's not a struggle for them, especially in the short term. We've seen this happen in different markets, so it can be considered for Kenya as well. In Nigeria, they created a mortgage warehouse funding facility or company that then provides the pre-financing to primary mortgage lenders. And in Tanzania, the TMRC introduced a pre-finance loan that's offered to new PMLs who are coming in before they can refinance their first portfolio. So these are things that can be considered, and these examples from Nigeria and Tanzania can be used as benchmarks when looking at the Kenya situation. So that's it. This is just a summary of those recommendations that I've gone through. So I think we'll hand it back to Lucy for the Q&A. Thanks.
Sorry, Stephanie, if I may come in. Thank you so much for walking us through what was really a very, very, detailed and thorough presentation. So we want, Lucy, my colleague, will be handling the Q&A. So please do prepare your questions, all participants. I'm getting a lot of questions about sharing the presentation. That's part of our ethos as open access. We'll be sharing the presentation and recording, and we encourage others to share it widely. I wanted to just make a few comments on what we found very insightful from this presentation, and also building on my own journey. So one of the recommendations is really to support improving the way financiers can work through a default. And that presentation of the slide of it can take up to 208 days is very startling, because that's what really is a barrier to lending for housing. When we have such high interest rates prevailing in our economy, and a financier could take the easy road and lend to government bonds, etc. If it becomes so difficult for them to recover in case of a default, that is a real important policy angle that stakeholders need to work together to do. And I remembered when I went for the first housing finance course for Sub-Saharan Africa and emerging markets in 2005, so 20 years ago, which was taught by Professor Maria. And in the room, there were all the policymakers from different countries and bankers. Everyone wanted to learn about securitization. And the principle laid out was, please enable the building blocks of how finance to flow for housing before you even think about securitization. And the building blocks have all been uncovered in this presentation. So one, make it easy to charge a property for mortgage. Our costs are too high. What can we do about that? I've been at the forefront. I'm a registered valuer under the Institute of Surveyors of Kenya, saying, does it make sense to develop our markets to hold on to scale fees? The effort is not related to the value of a property. Sometimes a very small property is harder to value than, the same property that could be multiple units, similar flats in a large development, etc. And there isn't much support for that narrative, even though there is a competitive authorities notice that was sent out, I think in 2021, saying professional bodies insisting on scale fees is anti-competitive. This has not been removed. So that's one thing we really need to think about in terms of driving affordability and economic growth. The second is also, as we said, making it easier to enable SACCO members who have purchased a parcel of land to build. We all know several people in our networks who have tried to build and been shocked by the high cost, the difficulties in finding, the right plans, etc. What should have been a 1 or 2 year project really gets dragged out. On that, we're pleased to say we are supporting a new initiative that is trying to make it easier for landowners to build. That's by showcasing sample plans, enabling them to know what the BQ would be on plans selected, and enabling them to order materials as required as the project ongoes. So that would be quite suitable if it succeeds. Again, it's a pilot to support the thousands of landowners in Kenya to start developing on their land without the uncertainty they currently face. And that really does require the pre-financing facility that Stephanie mentioned to enable SACCOs to commit more of their book towards housing construction, because housing construction construction finance continues to be a big gap in our markets. Banks are charging pretty high rates. The risks are very high for all the reasons we know. KMRC is helping with the offtake, and we can see SACCOs are coming in their way to support with construction finance, but how can we really open the tap for that? So with those comments, I would like to again just say that the study itself really helped the participating SACCOs. All the 19 SACCOs were given their own diagnostic of how strong their data was and how easy it was to extract data, so they can go on and help to improve on that. And they also found that helpful. And with that, one more thing I must mention again on the foreclosure is both Egypt, that has got a very, very strong housing program. They've delivered 1.5 million houses in the last 10 years. They started with writing a good mortgage law. And when the banks who came in for the housing finance project saw that, very few banks put their toes in, and when the first few the defaulting mortgages were able to be foreclosed upon in an orderly manner that could both had consumer protection for the home buyer and protection for the lender. And when those cases were well resolved in court, that's when the banks really came in. It just took 6 defaulting mortgages to be foreclosed. And then the banks got the comfort that we can lend. Separately, a very interesting case study is from Brazil, where the trust deed system was created in parallel. And now almost all mortgages go through the trust deed system in Brazil, because it was found the banks will not be, the court will always rule in favor of the borrower. And so a separate whole system was created where that balance of consumer protection between the borrower and the lender could quickly be resolved. And there's a third-party arbitration. And that's really led to the proliferation of good mortgage books in Brazil. So those were the comments I wanted to add. And I will hand it over to my colleague Lucy to help with the Q&A, please. Thank you so much.
Thank you, Sita and Stephanie, for those insightful comments and the presentation. So we have various requests requesting for the presentation. My colleague Collins has shared it in the chat. You can be able to go to the link and view the presentation from there. So we have various questions. And if you have any more questions, please put them in the chat so that you can be able to address them. We'll start with the first question from Collins, which asked that for the data collected from the participating SACCOs in terms of loan disbursed to members, were there any demographic differences? I think that has been answered from the presentation as we are moving on by Stephanie. We saw the difference in the male and the female borrowers from the different SACCOs. He also asked if there is any housing finance based on gender, generational, age differences, youth, occupation, level of education, and even place of residence. I think a portion of that has been answered. Stephanie, would you like to add anything to this, or Leonard?
No, I think that's been answered. We did try to collect some data on location, but we didn't have enough to add to the presentation. But I think from a demographics perspective, we covered that in the presentation.
Thank you, Collins. I hope that has been answered. Then we have the second question from Balvin Capital. What would make the interest rate go as high as 16% in a SACCO scenario, whereas KMRC is 9%? So we understand the KMRC aspect of 9%, but the aspect of the interest rate for SACCOs going as high as 16%, AIS, can you expand on that based on the findings and publishings?
So this was, from the data received, some of the loans had these high interest rates, and we can't disclose which SACCO at the moment, but some of these could also be some short-term loans backed by land and housing. That then, when you annualize, you get that cost. But yes, it's highly unusual.
Okay.
But it was in the data.
Thank you. So the next question also, I think, is to AIS. How are the incomes determined in the study for loan applications? Is it self-reported or were they verified by SACCO account data?
Yeah, so the income we used was what was provided by the SACCOs. So they collect it based on your payslip. If you have formal employment, then for businesses they have a way of calculating it. But then most of the ones we had were actually from payslip data from the SACCOs.
Thank you. So the next question was from Alice. Are you able to influence the lowering of the upfront charges in mortgage uptake? 9% is quite high. I think this is open to any of the panelists.
Thank you, Lucy, and I think I'll take the question by Alice Mburu. where my reading of that is around the upfront incidental fee relating to stamp duty, valuation fee, and other charges that are required to close on the mortgage origination. And I think if you look at the product offering that KMRCs are providing through the SACCOs and the banks, we have a provision that allows the end user to finance those closing or incidental costs, the stamp duty, the legal fees, and the valuation fee, which is often a barrier to entry or rather owning a home. So today, the loan to value in technical terms, the amount that you can access from your SACCO or a financial institution that provides a KMRC product, there is a provision for 105% financing. And this, to some extent, therefore addresses the upfront charges that Alice is referring to. So that's already a feature in our product that we are providing to the end users. Thank you.
Thank you. So Alice, I hope that is answered. Yes, Leonard?
Yeah, sorry. Yeah, we thanks Josiah for that. But just also to acknowledge that, yeah, the KMRC solution helps to offset those. I think Alice's issue is that the costs are way too high. So how then can this be reduced? I think that's something that the policymakers, I mean, like standardization of some of these fees or setting minimum, for example, valuation fee for KMRC mortgage maybe needs to be within this range, giving direction. I think those are some of the steps that would be welcome if actually they could be implemented. Yes, we do acknowledge the effort to do 105 and all that, but I think it's more outside KMRC. How can this cost actually be reduced?
Yes, thank you, Leonard, for that. The next question we have is on the link between mortgages and the economic activities. Is there, for those who are not in employment, did they participate in this? And is there an insight between individuals and corporate borrowers? So this goes to AIS.
Yes, so the immediate answer is yes. These mortgages are taken up by both business community or self-employed people and also people in formal employment. Some SACCOs have products that are tailored towards both types of incomes, basically. Normally having shorter tenures for people in business, but then we also found that that's what people in business prefer from speaking to self-employed people in the focus groups, and then longer tenures for people in formal employment, just because they have that permanent contract and regular income coming in from their payslip. But they are taken up by both types.
Thank you, Stephanie, for that response. So the next question, I think is very pertinent. Can KMRC and by extension the SACCOs consider removing the time cap placed on refinancing existing mortgages? For example, refinancing of mortgages taken before 2021.
Thank you. And again, I'll take that question by Pamphil Capital. And just to provide the context around why the refinancing of mortgages are taken before 2021 today is not eligible in the refinancing that we provide. And I think when I made the opening remarks, I did indicate that the KMRC was established in 2018, then licensed and regulated by the central bank in 2020, and we began our operations in 2021. So the intention really is to ensure that the targeting of the funds are applicable to new home loans that were originated from 2021 going forward, so that it's not retroactively applied to any mortgages that were provided before the establishment and operationalization of the KMRC. So that was the thinking around why the refinancing of mortgages pre-2021 therefore couldn't be accommodated.
Thank you, Joseph, for that. Thank you. I think that is answered. So we have more questions in the chat. Mary is asking, what practical steps should a SACCO take to position itself for housing financing? So I give it back to Joseph.
So thank you again for that good question. And one of the things that I had mentioned is the fact that at the onset, that's between 2021 and 2024 June, we had a few participating institutions who benefited from the funding that we provided. But we have since amended and widened the pool of eligible institutions. And in this case, we are in the process of onboarding additional primary lenders, the SACCOs and other financial institutions that are prudentially regulated in the sense that they are either regulated by SASRA or by the central bank. So in that sense, therefore, we continue to have engagements with SACCOs that in the past have not had an opportunity to benefit from the refinancing that we provide. But that window since July of 2024 is now available, and we would be glad to have conversations with the SACCOs that would have an interest in benefiting from the refinancing from KMRC.
Thank you, Jose, for that. Another question is, did we have access to information indicating the percentage of mortgages used to finance owner-occupied housing versus rental property? This goes to AIS.
Yes, we do. So we split up the mortgages. I can go back to the slide, but we split up the mortgages based on what they're financing. And we did have a split of those that are financing single occupancy, residential for multiple, basically residential for rentals, and then commercial. So it will be in the presentation that it's shared.
Okay, thank you. So Esther is asking, I think this goes to KMRC, are you onboarding the shareholder lenders?
Thank you. And I think for the decision that we took to open up the refinancing window, the consideration is to onboard the primary lenders, the banks and SACCOs, not as shareholders, but as beneficiaries of the funding that we provide to the market. We look at that window in the sense that it allows the SACCO to obtain refinance from the KMRC for purposes of supporting the end users. So the intention really is to ensure that the SACCO, whether shareholder or non-shareholder, can benefit from the funds that we are providing for purposes of home ownership. So the answer to that is we aren't onboarding them as shareholders, but we are saying that the portfolio that they have financed is eligible for refinancing as long as that portfolio meets the eligibility criteria that we have set for any participating institution, be it shareholder or non-shareholder. So that's my response to that. And back to you, Lucy.
Thank you. So we have additional comments. I think we are done with the questions. There's a comment from Monica, who is looking forward to seeing this targeting SME owners. And I think from the presentation, we've seen that we have salaried people and we have business owners who are able to access mortgages from SACCOs. So the intent is to encourage SACCOs to onboard more self-employed people to be able to take mortgages. The other comment you're seeing from Alice is a recommendation to embed compulsory insurance solution in case of job loss or temporary disability. This would encourage more mortgage uptake. I think that is it from the comments. Silas is requesting for contacts for Josea from KMRC. So I think, Josea, you can be able to share your contacts that can be reached. The presentation has been shared again. The link is there in the chat for anybody who wants to go through the presentation. That's it from my end. Take it back to Sita.
There are a couple more in the Q&A. Have we addressed those? Please.
Yes, we have. I think there's one. There's one from Kezia that has just come in. I think we've responded to the others. Do you offer mortgage to board of directors of SACCOs? Is there any policy? So I don't know if this is meant for KMRC or this should be a KMRC question targeted to KMRC.
So if my interpretation of that question is as to whether a director in a SACCO is eligible for a mortgage, my answer to that is all Kenyans are eligible for the mortgages or home loans that are provided by the SACCOs and the banks, and is eligible for refinancing by KMRC as long as they conform to the eligibility criteria. So that would be my response to that. Not too sure whether that question really is about the directors of the SACCO having to benefit from a home loan provided for that SACCO. But the point is all Kenyans are eligible for the home loan financing through KMRC provided through our partner banks and SACCOs.
Thank you, Josea. And I think that is also subject to the SACCOs credit policies. So whether they allow or they don't. So I think that is subject to each and every SACCO. So there is a request to share contacts. I think we will share them on the chat as we move. Sita, I want to hand over it back to you. Thank you.
Thank you so much. We have a few more minutes, which if anybody does have questions, I would also really like to invite Mr. Evans Kimosop from SASRA, who has been the energy behind this on SASRA's side. Please, Evans, if you could give any of your thoughts, we'd really appreciate it.
Thank you, Sita, for the invite to have this talk. Hello?
We can hear you perfectly. And
okay, thanks for the opportunity. Thanks for the SACCOs that participate in this study. I know we were ambitious enough. We had a quite number of SACCOs that we requested, around more than 40, and with 19 of them that came through, we appreciate the effort on it. There's a question that was raised on the issue of what practical steps can SACCOs take to improve housing financing, and I could add to it on the issue of SACCOs doing more deposit mobilization. We have cheaper deposits, which can improve the liquidity positions, and in additionally improving the loans having long-term repayment periods from the current traditional 84 months maximum, given the fact that most of the mortgage products, they take more than 10 years for repayment. And based on how SACCO operates, is most of them are repaid within 84 months, which is around 7 years. So in this case, maybe SACCOs can develop policies that can accommodate long-term repayment periods more than 10 years, which can easily be applied by KMRC as a refinancing combine all of it. Additionally, we would like to thank AIS Capital for the work they have done. The report is quite insightful, as the participants have brought it up, and it's one of the reports that we could use also to drive some policy interventions towards the availing funds through partners for the SACCOs. Thank you.
Thank you, Evans. Sita, just before we go back to you, I have two more questions. There's one from Yusuf and skipped. Sorry, Yusuf. So Yusuf is from the Comoros, and he's asking if this applies to them. So the response here, Yusuf, is that this is for the Kenyan context. However, most of the things affecting Kenya also affect other African countries. As you see our host here, Center for Affordable Housing Finance, we work together to be able to come up with initiatives that support not only Kenya, but other African countries to enable all the countries within the Center for Affordable Housing Finance to be able to come up with policies that support affordable housing. So in as much as this is in a Kenyan context, some of the lessons and learning can be used in other countries. So it can also be applicable to your country. Thank you for that. There's one last question from Jorim. I think this one goes to KMRC. It also came up as part of the studies as you're undertaking it. Why are you not onboarding non-deposit taking SACCOs?
It's a gradual way of beginning to now bring on board additional partners for the refinancing program that we are rolling out. And that's not to say that the window is closed for non-deposit taking SACCOs, but as we continue, we are also looking at other partner institutions that we can bring on board for refinancing purposes. But at the moment, we are looking at the prudentially regulated institutions for purposes of refinancing. But I think there are opportunities going forward for KMRC to consider those other institutions that currently are not eligible for refinancing. Thank you, Lucy, and back to you.
Thank you. Sita, can I give it back to you now?
Definitely. So I think it seems we are out of questions, and we can conclude. I just want to make the same points again from the recommendations that we feel really grateful we've done this study. We really are happy with the open access initiative that was embedded in our DNA when FSD was launched. In fact, I was working for the Center for Affordable Housing Finance as a consultant to do a strategy for the FSD network for affordable housing. And even though I work in affordable housing in Kenya, I was surprised at the initiatives that different institutions had tried, yet their impact was less than envisaged at the start because there are barriers along the whole value chain. So as part of the strategy, it was agreed that any partner we work with would support the open access initiative where what we're saying, it's not access to data that's the problem, it's the application that's your IP. And I'm known to say this over and over. I have more than 100 building plans in my laptop from different developers I've helped to do feasibilities for, or different consortiums I've been part of for the last 15 years trying to promote the affordable housing agenda in Kenya. Yet I will not be a competitor to that developer. I cannot take those plans. I don't have the balance sheet. I don't have the financial relationships. I don't have the risk appetite. You know, it's every institution's own track record and relationships and trust that is their IP more than the data. So that's been a big part of our joint effort. Other partners in the Open Access Initiative when it was launched are, of course, the Center for Affordable Housing Finance, but also REAL, International Housing Solutions. And they're also sharing data of the work they do, including the whole FSD network. So I want to make that appeal to all stakeholders. I also want to draw your attention to all the very many webinars we've been disseminating this year that may be useful to stakeholders in Kenya, in other countries. Yusuf, I see you've also made another comment about the problems. Yes, these problems are continent-wide. So please do look at them. Some of the most interesting ones and relevant to today's conversation are a building cost analysis and a time analysis we did with an impact fund and CAF on on two typologies. One is in Huruma, which is an informal settlement in Nairobi. How is a housing cooperative there building on ground plus one? The costs were actually very low. There's a design shared. How can we replicate this potentially on parcels of land owned by SACCO members? And really, if we can find a way to overcome that construction risk, then imagine the ability to recycle that construction finance. If you quickly can build in a year, quickly get approvals, don't have very expensive architectural and other professional fees, definitely need them, but have the fees be very moderated to enable faster delivery, and quickly build the building so that they can be refinanced to the right financier that can take offtake finance risk. Because it's the construction finance that's been a big hurdle and continues to be a big hurdle. So that's one. It's called the Huruma Chronicles, and we'll share that with all participants as well. The second one is we looked at different typologies of how to build very small apartment buildings, because most of the delivery in cities like Nairobi is actually being done by the small landlords for rental. 92% of Nairobi rents, and most African cities rental is very high. So we looked at typologies from single rooms, sharing a toilet and a bathroom, which is very common for most of the working stage class households. But how can you do it better? So there's ventilation, there's good circulation. We've created designs and shared them, BQs and shared them, financial models, bed sits, and 1 bed and 2 bed units. That's called Exploring Alternative Typologies for Low-Income Earners, really focusing on if we could get a blended blended cost of construction, we could yield these rental assets for between 8 to 12%. Which is, again, maybe not as competitive as what our treasury rates may be, but when you look long-term, a long-term 12% is a really good return if we can start delivering these units and getting the credit history of the tenants who can then start looking at home ownership at the next phase of their life. So I think those are my closing remarks. Again, thankful to everyone. I'll just ask again to any of the panelists if they wish to say anything. Otherwise, I don't see any other questions. We can close it out. Any of the panelists, last comments?
None from us, Sita. Thank you very much.
None from my side.
Thank you.
None from my side as well, but just to encourage that we carry on with the conversation to ensure that at least we are supporting Kenyans to affordably own homes. Thank you.
Thank you, everyone. And just the presence of Mr. Sandagi, Acting CEO, KMRC. I know Mr. Johnson Oltetia, CEO, Acting CEO, Mr. Sandagi, Acting CEO of SASRA. And I know Mr. Johnston Oltetia, CEO of KMRC, really wanted to be here. He's held a board position at the African Union for Housing Finance. So we all know that this is an important conversation. We're grateful to the participants, and please, let's find ways to implement the recommendations because they're very implementable. They're not pie in the sky ideas. They're ideas that we can do. We can create a pre-financing facility for SACCOs to start creating the housing finance products, because housing is very capital intensive. So it's a lot to ask a SACCO to commit a part of their book. So that's one recommendation I feel that we really need the financing stakeholders to come together for. Many of the others need a lot more policy support, but they've been outlined, and we really look forward to continuing to work with all stakeholders to implement this. I also want to mention that we have a donor coordination group chaired by FCDO where we shared this presentation, and we continue to try to make efforts for the housing finance information we uncovered to be shared with others. So thank you to all, and really grateful for the fantastic turnout and the work of everyone in the task force to make this happen. Thank you and goodbye.